The financial landscapes are shifting out there in markets, but are you willing and ready to adapt? With the Federal Reserve's recent bailouts of Silicon Valley Bank and other regional banks, we now know that something has shifted. Not only will the lagging effects of the Fed hike impacts be felt on the economy, but more importantly, they've probably been brought forward. This brings us to a very interesting point over the next 3 to 6 months in markets, and we need to discuss all of the key reasons that you need to be paying attention to this right now. What are the real impacts on the markets? Let's check it out. Well, welcome back everyone to the Daily Show where we talk about markets around the world, and let's begin with the major news stories. As per usual, if you're new to the show, consider subscribing, smash that like button. Welcome to the community. So yes, the news. Well, it's all about money supply at the moment and credit crunches. Yes, so we're heading for 6 months of contraction of the M2 money supply. And what does this mean really for us as traders and investors? Well, it means this simple thing, and this is taken from Mish Talk's website. Basically, the contraction in money supply coupled with a rise in interest rates has reduced the desire of banks to lend and the desire of businesses and individuals to borrow. I'd like to simplify that. One word, debt. We are seeing a credit crunch that is going to affect debt borrowing. We're not going to see a huge amount of people willing to take risk on. And what's that going to do to the GDP? It's most likely going to crush it back down. So the bonds market traders could be very correct on this one. And of course, it's something that the bonds market traders have been saying for a while. A recession is coming, and it probably is not going to be as soft a landing as everybody feels. Now, I know that's hard to see in the markets right now, so don't worry. We'll talk about why the markets are going up at this stage. But we still think a turn's coming, and it's all about timing is everything. Unfortunately for Burry, that's also been a thing out there at the moment. Even today, he was saying he's sorry about some of the things he said recently. I don't know what's going on there. But what I do know is that timing is the most important thing in markets whenever you're considering bullish or bearish bets. So what else is happening in the news right now? I just need to bring this to everyone's attention. Obviously, the US dollar is starting to see the impacts of a currency war. Effectively, we're in one. And let's face it, it's big. It's a big deal over the next decade. It's not going to affect the US dollar straight away. But we're not going to have, I believe, 80% plus of all transactions going through the US dollar over the next coming years. And this is just another one. China, Brazil, cutting costs using the yuan and basically clearing, of course, a whole bunch of trades through that. This will become an overarching impact onto the markets. Before we jump into our analysis on what's really going on here with the GDP and the impacts that are most likely going to be felt by the economy quicker thanks to the Fed's actions and Silicon Valley Bank, I want to talk about the positives. And the first positive has to be a pretty good stat. And that stat's going to come in over the next 24 hours. Well, unless there's a watershed style moment in markets. If we don't go underneath the December lows of the previous quarter in Q1, we tend to have a very nice statistic. Now, of course, we're coming into the last day of the month, and I don't think we're going to go under 37.83 over that period. I think that would be pretty wild. But whenever we've seen this in the past, there are some very positive correlations. Now, of course, these are just stats. Every time is different. But it shows you here that the average is very, very good. I mean, we're talking about 12.7% from this level from the reading. So that is from basically the 31st of March closing off. We've got 92% of the times it's read like this and been positive. It's a very positive stat. Now, are there outliers? Of course, there are. Here are some of the ones that we've seen. And more importantly, there are max drawdowns that we've ever seen. 23.2% has been the worst drawdown from a reading like this, and it happened in 1987. Now, could we get a 20% read down? It's possible. And if that comes, it's 32 kind of 50-ish, around that level, that 3200 kind of zone from current levels. So that would make sense to one of the worst case scenarios should we start to take a bit more of a hard landing due to the credit crunch that's up and coming. Now, if we'd invested $1 back 70 years ago into the markets and we just bought between April and sold into December, then we would have done pretty well. I mean, obviously, this is a very good looking chart, and specifically it's done amazingly well over the last decade. So it's a pretty good stat and certainly something people are paying attention to. The other thing I want to bring attention to has been how many retail traders are shorting. So over on Twitter, I shared this over the previous video. We talked about it. And we talked about the idea that there were too many puts in the market, and it's one of the big drivers of why we're seeing this squeeze in the markets at the moment, squeezing out all the bear shorts. And we've now got some really good levels moving forward for the S&P 500 that we'll look at later on today's video. The other thing that's been happening recently is, of course, the Federal Reserve has effectively injected funds into the market. Now, this is good for two things. Well, one thing in general, and that's growth. If you ever see the balance sheet increase, especially with rate cuts at the same time, although I haven't really proven that to be the key thing for driving the tech stocks, we tend to see it go straight into tech stocks. Now, we have a little decline here in the taper. You could argue that the Federal Reserve's never stopped tapering. They've just injected. But look, it's one of the big key reasons why the markets have been moving up. And I think we should never look at the asset sheet and ignore it. This is going to be, basically the buyer of last resort is the Federal Reserve. So we have to continue watching this. Now, a few people that have been watching this channel for a while would know that I've got my own way of looking at this. I can tell you that where we're facing at the moment is basically neutralized. So we're not injecting any more as of today. However, we're also not reducing it at a super significant pace. Let's go back over to this chart now. So basically, if we had a normal landing, we would sit like this and we would not, of course, see a slowdown in US GDP. However, if we did see a slowdown, it was expected to be kind of like a soft style landing, or at least trying to engineer a soft landing by the Fed hike impacts. I think the thing is, though, now we need to consider two things. One, we've got Fed hike impacts, but now we have tighter credit conditions that are being brought over by regulation and, more importantly, the Silicon Valley Bank incident. Now, Apollo has done some work on this, and they've been mentioning recently that they believe, and I'll just bring this up here, that they believe that the federal funds rate has actually been moving about 1.5% up. So they've actually estimated that it's 1.5% plus impact of what's just happened with Silicon Valley Bank to the credit crunching cycle. So effectively, it's put another 1.5% on the current federal funds rate. So if we push to 5.25%, that would mean that we're basically going to 6.75% plus in terms of effective federal funds rate. Now, that's pretty scary when you think about it, because, of course, that would be pushing well above, or pretty much into the inflation numbers. But I do think we're probably combated inflation for now. We are now not dealing with an inflation story. Instead, we're dealing with how much damage did we just do? We know the Fed is pivoting. We've talked about that many, many times on this channel by using, of course, the US 2-year and the funds rate. So if you put in here the US 02Y and you load that onto a chart, basically whenever you see the 02Y go underneath the funds rate, which we saw recently, that means a pivot's coming. So I think it's pretty clear that a pivot's coming. I think it's pretty clear that the Federal Reserve will usually sit on the pivot for a while, like they'll usually sit on it for a while, and the market is going to want support, especially when they start to sniff out this crunch in the economic cycle. Will that come in Q1 earnings? 14th of April, I think we kick off with JP Morgan and Wells Fargo. That's going to be a big one. I'd suspect it's actually Q2 earnings that we're going to find the really bad stuff, but it's something to watch, and I think this is the story. Let me know in the comments down below what your thought process is around this right now. Let's jump on over to some of the things that are going on. We talked about XLF. We talked about financial insiders starting to buy the dips. Maybe they think it's a little bit oversold. We also know that we're going into one of the better times for the market. So it's actually possible the markets could rally here. And then we keep in the back of our minds, though, that there is a sickness here and there will just be a timing. And it's all about timing to get it right. So yes, we're going into one of the strongest times of the year. Yes, we're going to April, which is literally the best month, and all of these types of things. We also saw this share from Michael Burry, and he basically came, well, it's a Bloomberg share, but basically it says here, bargain hunting is alive. 2023 is shaping up to be the second best year for the dip buying strategy pretty much ever. It's one of the best ever for buying the bottoms. Now, that's fine and all. But it doesn't mean that it's a real rally. It just could be a false rally still. Yes, breadth looks okay, but we've got two economies. If you look at the financial sector or the industrial sector right now, they look horrible. Whereas if you look at staples or technology, they look great. So we're going to have to play it round. But don't worry, I wouldn't be FOMOing too much, because even though markets look fantastic, I think even this chart here that shows you if you have 2 consecutive quarters of gains, which we're technically moving into at this point, yes, there might be some lowered returns, but then there's usually a horror show that comes in that really rips off a bunch of that. That's what happened in the global financial crisis, and that's what tends to happen after most of these nice runs. Fortune favors, I guess, the patient in this case. Now, why could we say, well, being patient is worthwhile? Well, being patient may be worthwhile for the longer term player because we know that when Feds pivot, or when it's ever happened in the past, after a massive rate hike cycle, they've broken something, you get tighter credit conditions, which we can already see starting to occur, and that puts pressure on the GDP and puts pressure on earnings. And let's face it, if earnings are bad, you can't have high fundamentals. You're just not going to be able to do it unless the balance sheet is increasing at a fast rate. So look, hey, don't get me wrong. If the balance sheet goes to $15 trillion, better get on board that train because it's going to move into those asset prices. And I'm not saying that won't happen. Anything's possible. But I would say in this case, the Federal Reserve's best case here is to beat inflation and then to support and accommodate the markets as much as they can, but they won't be fast to it. Remember, they've got to push inflation, that's core inflation, underneath the federal funds rate, which I believe it's going to be working now. Then they've got to hold it there for a while, and then they can start cutting. The market is expecting cuts much, much faster than that. So Fed pivots tend to actually lead into a rally first, then we dump. In fact, that's what's happened in the past. So it's not unusual for this to occur. So we know markets are following the no recession path. We went back to here. We're now about here at the time of recording for the S&P, and we're following the no recession path. The no recession path is all good, soft landing, it's all great. What if we go into a recession? The bonds market suspect that's happening. Credit crunches are coming. It's probably likely that that does occur. Now, of course, you can always be wrong, but that's probably very likely. We also know that these things happen. EPS growth turned negative recently. That's not usually a great sign for markets. We can go into kangaroo style, such as this red line over here in the middle in 2015-16. We also know that ERP is certainly not being considered here in the markets. Equity risk, that's not going to happen right now, but it does tend to happen during recessions. Morgan Stanley's Mike Wilson did some work on that, and I think it's worthwhile considering. Let's now jump into the markets though, and bring it all back to some of the key levels that we're looking for the S&P and everything else. So first up, 24 hours ago, what did we see? Well, basically, these are the moves in the markets over the session. We saw technology, consumer discretionary, and then defensives kind of hold through. Financials came back in the middle. Now, there was a sell-off in the morning. That was fairly predictable. I'll show you just a kind of thing I put in the community. It was a key level, but this is a very critical zone that we find ourselves in markets. So let's jump on over to the charts, and we'll start off here with the US 2-year versus US 10-year. It's still heavily inverted. Now, generally when the inversion turns off, so that is that the bond yield goes from kind of the positive inversion side to underneath and actually stops inverting, that's when you usually start to see that recession coming through. Remember, it's very unlikely you ever get a recession when you're actually inverted. It happens after it. If you think about over here, we can see that when we went underneath the positives over here, basically about November, we were very close to what ended up being a very fast recession, but I still think it was coming regardless. What about high yield bonds? Do they like the rally? Well, they do. I mean, high yield bonds are up and the market's up, so that's usually a pretty good sign for this to be a recovery rally for now. We've also got treasuries kind of holding in the middle. We've got a lot of central bankers around the world selling treasuries. We've got banks probably selling some profit in the treasuries, trying to reduce their risks overall, because we saw the other day how much they're holding on the balance sheet. Now, here's one that I was actually quite surprised couldn't hold up, and that's the US dollar. I thought the US dollar would hold through this and it would hold that 102 level. It just got obliterated back down. We're now at the bottom of this demand zone. And we've seen all this play out before, but it's probably not exactly where you'd think it would be. I would have thought we'd find more buyers here and then probably show some commitment to at least filling this gap. And you can see how close it got, but it didn't quite fill it, which is a pretty unusual move actually for the dollar index. Usually it does like to fill those gaps. So we're back at kind of like a demand. It's a little bit hard to read here on this chart. If you look at it from the daily close basis, you'd have to think rallies get sent back, like as in they get sold off. There's not much to like about this chart for now. And we have shown that the medium term is pretty negative towards the dollar index. So I guess it makes sense. But yeah, it got straight back up into this zone. It got here, didn't quite fill that gap. We'll wait and see here on the dollar index. I'm actually more interested in the stock market at this stage, and we'll talk about it why. What about gold? Well, gold moved through a pretty key zone. So it moved through that 1976. So it's found some buyers. Now that's because, of course, the US dollar has been weakening, and gold moved through what we would call like kind of the midpoint zone. So it could be going to retest these highs. And if it does retest these highs, it opens up the opportunity for a breakout. 2000 is a critical level. And it seems like it wants to make its move towards that level at this stage. Be careful here in gold. I mean, it is making a series of higher lows, which we can see here based on the trend lines through the back. So that's certainly what's happening at the moment. If that trend line is snapped to the downside, we need to be paying attention to it. And where we find ourselves right now is kind of moving towards that, as I said, that 2000 level. So going through these highs, projecting out, kind of getting into that just before 2000, there could be some sellers. But it looks kind of strong for now, and it's at what we would call an equilibrium zone, the fair value of gold at this stage in this market. Copper doing absolutely nothing. We trapped it the other day, and I guess you could move this trend line up here just because it's changed. But overall, it's just sitting at a key zone. I'd like to see copper fall off. That would be a good sign that the markets are going to find some weakness, but copper hasn't made the moves just yet. Let's move over to US oil. No break to the low side, so it looks like for now it's moving towards that 76, 77 a barrel, which puts us back into this supply range up here. So it looks like oil is doing okay, and that's just because rates are stabilizing. US 10-year, US 02Y, the market's starting to say, well, wait a second, I don't think the Fed's going to move that quickly. And it's trying to, basically get back to some kind of normality or equilibrium. So I still think that oil is going to decline over the next coming months, and it's still going to have problems. And you can see here that it moved down to one of our critical levels. I love that level where it moved to. But I could see oil even get up to 70 or maybe even 80 a barrel and then find weakness. So I'd be looking at 76, 77, and then after that, I wouldn't look at anything until 80. So they're the key levels for me for now. Let's move over to natural gas. How's the Widowmaker going? Well, it's still putting pressure on the down end side. And look at this. The last 24 hours have given us the new low. So I'm super interested to see how it trades around here. You can see it's bought off our little line. That's the new low. So new low has been formed, and we've seen some buying. It's a little tweezer here. And if we go to the 15-minute, you can see it's held it every time. This is where the buyers really need to recommence on natural gas. It's a risky trade, but it is at the lows, and I'd like to see strong buying coming off this force. So yeah, very, very interesting. It finally got there. We were patient. We waited for this level. Now we have to find out whether the buyers are recommencing. Remember, natural gas is an incredibly dangerous trade, and it requires you to be realistically open to 30% plus daily moves. I just want to put a disclaimer out there, because while it has hit a technical low, that doesn't mean that it's just going to switch. It is a level where you could see people getting squeezed out, and now you're looking for that reaction around that point. And so far, we've seen buyers recommence. What about the old Tesla? Well, it keeps coming back to this zone and finding a little bit of resistance. Again, if the markets actually start to weaken, Tesla will weaken with them. Where's the key zone for Tesla to break through? It's got to be that 201 kind of level. If it gets through 200, that's going to be a big deal. We know how many calls sit on 200. We know how much premium the market's been bringing in. Do I change my thought process that Tesla will eventually get back down to here? Not really, but you're going to need a credit crunch that comes through, and the market will need to be fearful of that, and that won't happen until you get bad earnings. Let's face it, that's probably one of the big catalysts at this stage. Let's move over to some stocks. So a lot of stocks are moving through and leaving big gaps. So we're seeing 2 gaps now on Apple that haven't been filled. Now, if you've been trading for long enough, you'd know that when you start getting these kind of big gap on gap on gap kind of processes, you often come back and at least fill 1 to 2 of them. So here's like a gap followed by another big gap. Great run, looks great. FOMO comes in, everyone's excited, and then it gets dumped straight back down to fill a lot of that. So that's the type of thing I do think will happen, but it's all about, timing and whether we get there. At this stage, though, it looks like pullback should be met by buy demand. There's not much to really dislike about some of these closures. This weekly will be pretty big. if it closes up here in the highs. There's still gaps to be filled up here in the 171s. And while that may seem ridiculous, it's possible. I mean, these markets can go on some pretty big rallies. We've seen that with NVIDIA. No slowdown yet. I have said this for a while. Like, I'd love to short NVIDIA, but you can't short something that's not telling you to be able to short it. And if you do short it, you have to use something like options to be protected. It's very dangerous. So NVIDIA is still riding the AI bandwagon, and it's going incredibly well. I still think watch reactions at these highs here around 289 will be critical, but we'll talk about what the markets have got in store. No signs of weakness here on NVIDIA just yet. If we look at consumer discretionary versus staples, the American consumer, we're sticking around in the middle of nowhere. Move over to the DAX. That was a breakout the other day. It's continued its strength. You can see it's coming back to like a bit of a supply or resistance zone. I would probably see some bears recommence here, though I don't know if they're going to win this battle. I mean, I think bears might push down, but ultimately at this stage, it looks like dips will be bought for the foreseeable future until we expire a lot of these puts in the markets. Australian market coming near or close to the resistance zone of 7,200, which is what we've been talking about. Nice breakout, very nice move. We're coming back to the critical zone. I think this is a level that we should be watching on the charts. So 7,220 will be a big one for Australians. I think we need to be all over that if possible. Let's move over to IWM, the Russell 2000. Is the sickness really bad? Well, the Russell 2000 is not showing us much, but I want to look at the actual futures. The futures came off a level that I thought they should. We still have a series of higher peaks, higher troughs, higher peaks, higher troughs, higher peaks, higher troughs. So that's not telling us that there's weakness in this market just yet. But if we do get a lower trough, okay, well then we've got something from the US 2000. I suspect it actually might come down, and we'll talk about that, but I still think the buyers are probably going to recommence a little bit here in US 2000. Let's look at the daily. There's the daily closure. So it kind of looks like a bit of a shooting star. This is either a really nice distribution that's going to go really bad, or it's an accumulation Wyckoff. We don't know yet. From the surface of it, you would say accumulation Wyckoff based on the low steals. It depends on how it reacts up here, especially the 1800 zone, to whether we know it's a buying base or whether we suspect that actually it's a trap that's going to go super low. I think the Russell 2000 is heavily underappreciated at the moment. This is the true economy right now. 2,000 companies, plenty of zombies, lots of crunching to be done. So that's why it's down so low. The market already figured out that, you know, it's pretty efficient like this. It already figured out there's a lot of sickness here, regional banks, etc. But yeah, I think this is the one to watch. And we hit a critical. I can see why it shorted off. That was probably the best short of the last 24 hours. Let's move over to the Qs. The Qs, oh, it's a big monthly break if it does happen. So big monthly over the top of this other one. You can see here the weekly as well over the top, the daily looking pretty strong, but still some gaps to be filled. Now, we did kind of fill on this one, but we haven't even gotten close to that 307. And we'll talk about that soon because we've basically broken out. People do the FOMO. So the FOMO's happened. There's no doubt stop loss hunts that have just occurred as well, where people had stop losses above here and they've lost it. Sad face for them. So this is the type of time where you do see markets to turn, or they'd actually move down, and they could go towards these fills and then move backwards towards the forward. So let's use the S&P 500 as an example of this. This is the futures as we come into it. If the futures do keep rocketing, I could see it actually easily smash into this 13,200 zone. And if that happens, that's probably where that weakness would come through, and like something like this would occur. I think it's important to have the key levels on your chart. So let's get into the S&P. The S&P comes to the weekly options expected high. So here's the SPY, straight onto it in the last 24 hours, and it dipped in the morning and then rallied through. So I'll just show you, this is something I posted in our private community, and I just basically said that I found a pretty stacked zone. So I thought around that 40-50 zone, we'd find some weakness. Obviously, we did for the session. I'm not saying it's like soothsaying. You know, there's only a few points there, maybe 20 points, but it was a critical zone for it. I still believe around this level is pretty key. So let's move over here to the US 500 futures and break that down a little bit. So first up, we're in a zone that I think most people can see. You know, we know that we've got a 40-90 gap fill. We know that we have a lot of stop losses, I would say, sitting behind here, and we probably had quite a lot sitting behind there. So anywhere in this area is where bears could recommence to try to short it down. But will they even have any luck? So let's say scenario one. I'm going to give you a couple of scenarios here. Scenario one is that the market kind of just keeps plowing through. And if it does, I suspect it's coming to a 41.40 style zone, 41.35 to 41.55. Now, at that zone, people will feel extreme FOMO. It will have squeezed people and it will probably take some stop losses from people as well. If that occurs, it's an interesting turn point though, and I think that's where bears will try to recommence in this market. So if I was bullish on this market, would I be scared? From a technical perspective, you don't have any reason to be. Even if you suspect that this right here, right now is a higher high, and then over the next 24 hours, it makes a lower low, what is going to hold this market up? Well, I think it has to do with the gap fills. We actually didn't properly fill the previous 24 hours of gaps. So if we go in here and we scroll in, what you'll notice is the market came down and it hit like wick to wick, but it didn't quite go to the close. So we have an unfilled gap technically at 40.27, and then we have one left behind at 39.70, which just so happens to be, if we get a short off here, a very well traded zone, plus it would line up with that trend line, plus the top end here lines up pretty well as well. So let's just quickly draw a little bit of a trend line through here. You can see where I'm going with this. We're getting to pretty critical levels. You know, if we follow the general trend here of markets and how they've kind of traded, we could almost say, okay, well, if we grabbed a fib and we actually took a fib here of the whole move and we took that up to the high, that would then bring us to a 61.8 retracement, which would bring us to the trend line, which would bring us into, you know, this whole run that's happened so far, and it would look pretty sneaky. So what happens here could be pretty critical. Now, I've kind of done some extra work on that and said, well, what if we had here high, and we extrapolate that out? Again, there's a lot of intersection with these points. We've got unfilled gaps just above. We've got hunts that would occur. We've got trend lines that would occur. Now we're in the pocket of where, you know, if I was buying, would I buy here? Well, probably not me personally. I mean, you do whatever the hell you want. I don't mind. But you know, the thing is, this is a critical zone. If I was in longs, would I be scared? Well, I don't think you have to be scared, even if you see these levels, because at the moment it's pricing that down here should technically see buyers. There's no real worries here. So I think a lot of this comes down to we're hitting criticals, we're hitting turn points, and then we have a lot of buyers that are going to be very committed down here as well. So we've got critical levels coming up for the S&P, and it's a totally different big shift from where we were on Monday. Now, I know Monday, Tuesday, the market's rallied through, but there's a big difference between when you can see key levels and not. Now, I've already suspected some of these zones existed, but this is a rally that now has left several gaps behind it. If we get another one today, which remember at the time of this recording we're up, so we could get another gap, that'd be 3. That's massive. So if we get 3 gaps up, there's usually a pullback. And that's why I always say patience, react, don't predict. It's better to actually look for the key levels, see the reaction to them, and then go from there. So a lot of line work here, I understand, but certainly a very critical point here for markets. And I do think we're getting super close to those. So big weekly, big monthly, huge stuff going on here. Definitely check it out. Another thing to note, and we'll refresh this, is going to be where we are in comparison to the call options expiring on the 31st. So we're not really at any of the critical points. Anywhere between 390 and 410 is cool by the market, in my opinion. Yes, max pain is 397, which is lower than the current price. But realistically, 410 is where the big calls are. I doubt we get through 410 over the next 24 hours. Hey, you never know, but certainly is there. Let's move over to Bitcoin, because a lot of people love the Bitcoins at the moment. It's still in an upward trend. It did change though. So we kind of went between a high and a low, and then we had a higher high, and then we got a lower low. It's not as good as it was. I was really hoping that we would see Bitcoin hold that level from the previous 24 hours, hold this low, and then just see that nice run to 32. It's not ideal. I don't like it. I don't like what it just did. I'll just say that right now. Could it still go to 32, 30,200? Sure, but I'm not a fan of that price action over the last 24 hours. It's the type of thing that makes you go, wait a second, is that a UT? Is that a Wyckoff? what the hell is that? We start questioning this. And yeah, I can't say I like it. I don't know. Let me know in the comments down below. I'm not really invested in this at the moment. I don't care too much. The money that I have in it, I couldn't care about what it's doing at the moment. But yeah, that could be certainly setting up for a Wyckoff top. UT, change. If we get shorting and we come back down here, watch out, crypto. And at this stage, yeah, I think it is a bit of a swing story. So that last 24 hours kind of changes my opinion a little bit. That's how fast things can change. And yeah, that's the way I look at it. I mean, you can see the rejection here and the way it's come through. Let's move over to the news ahead. Friday brings us core PCE price index, which is going to be big. That's 8:30 a.m. Obviously, it will move markets up or down. We'll have to find out where they want to go to. Could spike those highs as well that we found on the S&P. So some good work there we've done together. So that'll be big. Remember, daylight saving shifts for Australians and New Zealanders that want to trade the US market, best market in the world. And if you want to trade that next week, you'll need to be aware of those changes. It's good for New Zealanders and Australians, actually. It brings it forward. And then we actually get some big news next week. So remember, the jobs numbers start to come out, and that's going to be the big data point the Fed's looking at. If you enjoyed today's video, remember to subscribe, smash that like button, and of course, follow us along on our other socials. Join us in Discord, Twitter, get involved in the community. And if you're interested as well, you can jump on over to our 3 free trading cheat sheets, totally free. Just put in the email and get it. We'll also be releasing, as I've said and promised for a little while, some extra information that'll be free. And yes, I'll put it out every month. So yeah, get involved. Why not? What do you got to lose? Thanks so much for watching. Subscribe, smash the like button if you enjoyed it. We'll see you in the next one, guys. Bye for now.